Hi everyone, I'm here to walk you guys through Form 1065. I understand that your copy of the text does not have filled out forms in the appendix, unfortunately. So for those of you who've never prepared a tax return before, especially a business return like a partnership or a corporate return, this is going to look strange to you. However, I do encourage all of you to use the instructions. So along with the blank form, I also gave you, those are the K1 instructions. Where are the, oh, maybe I've got two copies of the K1 instructions. And maybe let me know if I didn't give you guys a copy of the actual Form 1065 instructions. You can get that off of the internet, and all you do is go to irs.gov. I'll show you how I do it. Oh, and by the way, don't forget to listen to my video. I have a video, if you guys look in one of the corporate weeks and course content, I actually have a video of a walkthrough of irs.gov. But let me just show you quickly what you do. You go into irs.gov, you go into Forms and Pubs, click on Forms and Pubs. I don't know why this is being so slow right now. And then you go into list of forms and pubs, and then you type in the find box, you just type 1065 and press enter. And it's going to come up with Form 1065, it's going to come up with the instructions for Form 1065, as well as instructions and the schedules that go behind the 1065. You guys aren't going to be required to fill out all of these schedules. Your return's not as complicated as some other partnership returns might be, but as you can see, there's lots of different forms and schedules, and then the IRS always gives you instructions with each of the schedules or forms. So you would want to click on here, and it actually opens up the instructions in a PDF format, and then once it's opened up, you can just download it to PDF, however it works on your computer. Okay, so I'm not going to wait until that comes up. So here's the 1065, and here's where you fill out all of the, the name of the partnership, the address of the partnership, the principal business activity, product or service, and the business code number. Now you get I think I told you in this document here, which is, you can consider this the documentation that you would have gotten from the client in order to fill out the return. I told you what they do. They sell outdoor equipment. They're an outdoor equipment retailer. And so what you do then is you look in the 1065 instructions and see where it says here, codes for principal business activity and principal product or service, page 47. You go to page 47 and you look for the code that fits what your company is doing. So this is a retailer, so you would go to the retail section, and then I'm not going to do this for you guys. That's part of the test, right, is to see whether you're able to thoughtfully go in here and pick out the best business code for this partnership. Okay? So you would fill that out. You would fill out the name and address of the partnership, the employer ID number, the date that the business started. I think this is all in the facts in that Word document. And then if you look at the instructions, what the instructions are going to tell you is that item F, is supposed to be the total assets as of the end of the year, and that was given to you. So that's pretty easy. Now, if this were the initial return or the final return, you would check one of those boxes. And also, if they had a name change or an address change during the year, you would check the applicable box. In some cases, you might be amending the return. Now, an amended return means that you've already filed the original return on or before the original or extended due date, hopefully. And now you're coming back to file an amended return to amend something in the return that you want to change, either because it was an error or you've discovered a better, like maybe you forgot to deduct something, or you used the wrong method of accounting for a certain item. Whatever the reason may be, you are allowed to amend a return as long as it's within the statute of limitations. Now, for a federal return, the statute of limitations is 3 years, and that's 3 years from the filing date of the return. So if you had a 2015 return that you filed by the original due date, or let's say the original due date, and the original due date, by the way, is now 3/15, it's not 4/15 anymore. So let's say you filed it by 3/15/2016. You would have 17, 18, 19. You would have until 3/15/2019 to file an amended return. After that, the statute is closed, and neither you nor the IRS can come back to you to change anything on that return. So now you might also have a technical termination, and we learned about that, I believe, in chapter 10. Fortunately, none of these boxes are going to apply to you guys. Now, item H is where you check the accounting method, and it probably tells you that in the data, in the Word document, whether this partnership is using the cash method of accounting or the accrual method of accounting. And then you have to, in item I, you list the number of schedules K1 that are attached to this return. Now, you know from the chapter that the way a partnership a partnership entity works, is that it passes through all of its items of income and expense to each of its partners. And the way that the partners get their applicable distributive share of income and expense being passed through from the partnership is via a Schedule K1. So if there's 3 partners in the partnership, then you would put a 3 here, and you would have 3 K1s. Now, you could end up having 3 partners at the end of the year, but maybe you had 4 during the year. Now, how would that happen? Maybe you had 4 during the year because, but not only 3 at the end of the year because one of the partners terminated its interest in some way. It either sold its interest to somebody else or it liquidated its interest. And so you could have a number of K1s, even though at the end of the year, you really only have 3 partners, but you're supposed to list here how many K1s are actually attached, okay? So then, the rest of this page is used to show the items of income and expense, minus all of the applicable expense, that foot down to, or sum down to, ordinary business income on line 22. So you would add all of the items of income that are ordinary in nature, and you would subtract from that all of the deductions which are ordinary in nature. And then you come up with this bottom line figure, ordinary business income, okay, which is its net income. Now that amount then goes, if we page down to page 4, which is Schedule K, that amount gets transferred. Page 1, line 22, ordinary business income, that amount gets transferred to this line on the Schedule K. And then you might have other items of income or deduction which you're passing through separately to the partners. And those you have to show on different lines. So you might have ordinary income, and you might have some interest income, and you might have some dividends. Maybe even you sold something, an asset, and it could either be a capital asset, and if it was a sale of a capital asset, it would either go on line 8 if it was a capital asset that you had held for less than 1 year, or it would go on line 9A if it was an asset that you had held for a year or longer. If it was an asset that you held in your trade or business, then, and you held it for longer than a year, then it's called a net section 1231 gain or loss when you sell that asset. And so you put all these items separately, you list them separately on Schedule K. Why? Because Schedule K is then you're going to multiply each of the items on this page by each partner's distributive share. So let's say that Mark owns, and I don't have it up, let's go. So Mark is the one who we're going to have to fill out a K1 for, and Mark has a 33 and a third percent interest in the profits, loss, and capital of the partnership. So he is going to get 33 and a third percent of each one of these items on Schedule K. Okay? So you fill out page 1 to get your ordinary income. And then you go to Schedule K next, and you put whatever's on line 22 from page 1, you put it on line 1. Then you go back to your information and you go, what else do I have? What items of income and expense or deduction do I have here? Maybe I have some credits I need to pass through, whatever. What else do I have here that I need to pass through separately to Mark and the other partners? And so then I would fill out Schedule K next. This is the order that I'd like you to think about doing this in, right? Page 1 first, then page 4. Then you can go back and, well, then if you want to make this easy on yourself because it'll be top of mind, then you could go to the Schedule K1 for Mark and fill it out, okay? So here you enter the partnership's ID number again, you enter the partnership's name and address. This is all from page 1 up here. You have to figure out what IRS center the partnership is going to file its return in. So where do you think you go to figure that out? The instructions, right? So you would go to the instructions, you figure out what city and state the partnership is located in, and based on that, you're going to figure out what IRS center you're supposed to file the return. Now, if you don't know what something means on these forms or schedules, where do you go? You go to the instructions. If it's something on the 1065 you don't understand, go to the instructions for the 1065 that I just opened here. And don't forget, you can download these, okay? Oh, I guess you would download it here, right? And then you would, the reason my CPE is up yesterday, so my birthday was last week, so yesterday was the deadline for renewing my CPA license. Boy, that was like half a day. I had to actually take a 2-hour class. So I hope you're not going to procrastinate with stuff like that like I do. Okay, so make sure that you're checking the instructions because a lot of this stuff will tell you what they mean. So like for what we were just looking at for the Schedule K1, for Mark, Schedule K1, you'll notice that first it tells you, all about general information. They usually tell you if there's going to be something in the future that's going to change the look or feel of Schedule K1, they'll tell you that here. Or they'll tell you where to go on the website. They also give you general instructions like what is the purpose of the K1? The partnership uses Schedule K-1 to report your share of the partnership's income, deductions, credits, etc. Keep it for your records. Do not file it with your tax return. What the IRS is doing right now is it's speaking to the partner and showing the partner, telling the partner what the purpose of the K-1 is that the partner received from the partnership. Because the partner may go, what is this thing, and how do I deal with it on my tax return? So that's what is generally being said here. Then if you scroll down, you'll see that, oh, and by the way, here's a really nice worksheet here that the IRS has provided for the partner to be able to calculate his outside basis in his interest in the partnership. So he can use this worksheet to figure out what his basis is at the end of the year. Now, why would he want to know that? Well, he only gets to use, if there's net losses being passed through from this partnership instead of income, instead of net income, his basis, and maybe in prior years they had net losses too. Remember that if you have net losses and you don't have basis to absorb those losses, you don't get to use the losses on your return. So it's very important to keep a running record of your outside basis in your interest in a partnership. So the IRS has actually provided a nice little worksheet for the partner to use. Now, if you had a client, if you were working for an accounting firm and you had a client who had a partnership and you're in charge of preparing both the partnership return for the partnership, plus you're going to prepare one of the partner's returns or maybe all of the partner's returns, you would be tracking their outside basis in the partnership, each of the partner's outside bases in the partnership, probably like on an Excel schedule. You wouldn't go in here and do it, but they're trying to make it easy, and you could actually convert this into an Excel schedule if you wanted, right? Just by kind of copying and pasting it over and then right-sizing it into your Excel thing. They even explain here what the definition of a general partner and a limited partner is, and also what the difference between non-recourse loans and recourse loans are, right? We learned all this in the text, right, in the chapters, and we were tested on it. But as you can see, the IRS does a pretty good job here in the form instructions of explaining everything in layman's terms. They very rarely refer to a code section in the instructions. Now here you will see there's some code sections here, but honestly, they a lot of times will not refer to code sections. They try to keep it in layman's terms. So you can see here they talk about the basis rules that I just was covering, a minute ago. They also talk about at-risk basis, right? We learned about that. And then they talk about passive activity limitations. And you might remember from one of the problems that you had on the midterm that you were asked, it was basically a test of your knowledge of the passive activity limitations. But before you apply passive activity limitations, you have to figure out what your outside basis is first. Then secondly, you have to figure out what your at-risk basis is. And then thirdly, and in that order, you would figure out whether you have passive activity limitations. And this would be in the case of losses. And there's all of these rules, as you can see in the instructions here, for determining whether you are an active participant in the trade or business of the partnership. Because if you're not, then the losses and income coming through from that activity of the partnership are passive in nature to you, and they could be, and if the losses exceed the income and you don't have basis enough to absorb those passive losses, you won't get to use them on your return. So it's very important to figure out whether you're an active participant in the trade or business of the partnership in order to figure out whether passive activity limitations will apply to you. So then you get down to specific instructions starting on page 5, and that's where it'll explain these different items and line numbers and what you're supposed to fill out there, okay? So I wanted to point that out to you before we go back to the form so that you can see that it is helpful to have the instructions in front of you while you're filling this stuff out. So once we get done filling out the information about the partnership and the information about the partner, and here's where you list their beginning of the year P&L and capital share, and then the end of the year. Now, in our example, I think it's the same for Mark. His P&L sharing ratio is the same at the beginning of the year as it is at the end of the year. But in some cases, there could be a dilution of interest because somebody else bought into the partnership, or he could have sold part of his interest, or he could have contributed more property into the partnership for an increased share in his interest in the partnership. So you do need to pay attention to that because sometimes these figures will be different. Now, K is where you list the partner's share of liabilities at your end, both non-recourse, recourse, and then if there's qualified non-recourse financing. So you're going to have to understand the rules in order to know whether he gets any share of the liabilities of the partnership in our example. Here's where you list his share of the partnership's capital. And you'll from last year, if you look on last year's K1, you would look at the end of the year, and the ending capital account from last year's K1 is what goes up here on this first line where it says beginning capital account. Then if he actually contributed any property during the year, and they call it capital here, then you would list something on line 2. And then his capital account interest, his capital account increases or decreases by his share of items from the partnership. And then he might have there might have been a distribution made to him, and if there was, then that's a reduction to his capital in the partnership. And then you end with his ending capital account. Now, item L may or may not be on a tax basis, and I think the instructions tell you what to list here. They give you whether it's on a tax basis, on a GAAP basis, a 704B book basis, or other. But it's very often not on a tax basis, which means that his ending capital account here would not be the same as his ending outside basis in the partnership, okay? And the difference would be the book tax differences in the partnership, which I'm going to explain in a minute to you, okay? And then over here in part 3 is where you enter all of his share of all the items coming from Schedule K in the actual partnership return. And you can see that everything is all the numbered items here are laid out in the exact same way. They're in the same order as on the Schedule K1, making it pretty easily just to multiply all of the items on Schedule K by 33 1/3% to get Mark's share. Okay? So that's how you fill out the Schedule K1. It's only one page. Now, you notice here, if this was his final year in the partnership, then you would click this. Oh, by the way, notice that when this is a writable and readable form that the IRS gives us. So I can I can actually complete this form online, and then I can download it and save it to my hard drive as a PDF. So this is how I would do it. Right? I don't know why I chose Dayton, Ohio. It's just the first thing that came to me. Likely they would be filing in Ogden. But anyway. Okay, so that's what you guys are going to do. If you choose to fill out the blank forms that I gave you, or to go on to the IRS website and fill out the forms, rather than using that Tax Act software link that I gave you, then this is how you would do it. Now, the negative, the downside of filling out the forms that are supplied on the IRS website is that they don't foot for you. So in other words, when you're on page 1 of the, when you're on page 1 of the 1065, you know, you're going to want to add up. Line 8 is the sum of lines 3 through 7. You're going to have to add it up on a calculator, and I would do it twice to make sure that you get the right figure. Don't get points taken off just because you don't know how to add on a calculator, right? Or you're being sloppy. So that's important. Make sure, and by the way, and this is a true story, the very first tax return that I had to complete when I started at Arthur Young, way a long time ago, was a corporate return. It was a Form 1120, and I had a 25-hour budget, and I had to go into, and by the way, we didn't have computers with an IRS website back then, so I didn't have this kind of form. We had what was called a Package X, and it looked kind of like it was kind of a soft copy, kind of like your text looks like, with like a square back, and the forms actually were perforated inside the book, and you would rip out the form, go to the copier, make a copy of it. Why? Because you don't use the one in Package X, you might have to fill out 3 of those that week. And I had to go to the copier and make a copy of the whole Form 1120, which back then was 4 pages, and then I had to go back to my desk with a pencil and an eraser and fill the thing out by hand. And that our client actually used that return to file. So not that we did all of our returns by hand like that, but they made me do that my first return because it taught me how the form flows from the back to the front of the form and from front to back. And that's what I'm trying to teach you guys right now is, you know, on a 1065, line 22 on page 1 flows back to page 4, line 1. Now, in turn, and then I was asking you to fill out the Schedule K1 for Mark next, just because you will have already filled this out, so why not then multiply all of the items on this page by 33 1/3% and fill out his K1. When you're done with that, however, when you go to page 5, you'll see that we have something different going on. Now, one thing that we have is this analysis of net income or loss. And it tells you what to do here. It says on line 1, combine Schedule K lines 1 through 11. From that result, subtract the sum of Schedule K lines 12 through 13D and 16L, and then put the answer here. Okay? Make sure if you're doing this with your calculator, you know, do it 2 to 3 times to make sure you've done it right. Okay? Then here, when they say analysis by partner, you would say, okay, I have general partners and limited partners. I think I've asked you only to fill this out for Mark, not for everybody else. But if you have enough information, fill it out for everybody, okay? And what it does is it has you segregate this line 1. Let's say this is $100, okay? And let's say that I have 2 partners. One's a general partner and one's a limited partner because this is a limited partnership, and they share 50-50. And one of them's a corporate partner and one's a individual partner. Well, the corporate partner's the general partner, and he owns 50% of the partnership, so he gets $50. And the limited partner, who's an individual, owns the other 50%, so he gets the other 50. That's how you fill this out. Okay? Then your balance sheet, I'm not even sure that I asked you to fill out the balance sheet. I don't think you have a balance sheet. I don't think you have enough info. Yeah, I just told you, you only know what the assets are at the beginning and the end of the year, I think. So you could actually, from what you have here, Yeah, you can actually fill out the balance sheet, but only the totals, because you actually know what the assets and total liabilities are both at the beginning and end of the year. And we all know, if I go back to here, my dog's whining at me outside. I don't know if you can hear her. We all know that, well, I hope you guys know this. You might not if you haven't taken an accounting class. Total assets on a balance sheet equals the sum of total liabilities and total equity. And in a partnership, equity is synonymous with capital. Okay, so this line 21 where it says partners' capital accounts, that is the same as equity. Okay, that's the sum of all of the equity of the partners. And total liabilities and capital must equal total assets. So if I've given you total assets and total liabilities at the beginning and end of the year, then you guys should be able to fill in total liabilities and capital, because we know that total assets has to equal the sum of total liabilities and capital. Okay, so fill out the balance sheet to the best of your ability based on the information you've been given, and we'll see how you do. Next, you have what's called Schedule M1. And Schedule M1 is a reconciliation of your net income or loss per books with net income or loss per the tax return. And the differences are going to be the items, the expenses that are on the books of the partnership that are not deductible by the partnership on its return, or expenses that are deductible by the partnership on the return that are not expenses sitting on the books, or expenses on the books that are never deductible. Okay, so that's either a perm or a temp difference, or it could be income included on Schedule K but not recorded on the books, or income recorded on the books but not included on Schedule K. So you might have some tax-exempt interest income, which means that it's interest income that's recorded on the partnership's books, but it's not included on the return. In other words, it's not taxable interest income. So what you're trying to do here is reconcile the difference between everything that's on the books and everything that's on this return. Everything that's on the books in sum goes on line 1. So let's say if I have net income per books of $1,000, and included in that net income per my books is some tax-exempt interest income of $100. So really, I have $900 of book income other than interest income, plus I have $100 of interest income. So that added up to $1,000 sitting on my books on my income statement. However, 100 of that is tax exempt. It's not taxable to the partnership. So we list that on this line over here. And then let's say also that we have some expense recorded on the books, which is equivalent to a penalty. So it's something that's not deductible by the partnership, because a penalty is never deductible on a tax return. If you pay a penalty to the government, like you're late with your property taxes or your payroll taxes and you pay a penalty for that, that's a payment to a penalty to the government, and the IRS, in the Internal Revenue Code, it tells you the penalties are never deductible. So let's say you had a $50 penalty. Well, you can see there's no place to put this here. Normally on a tax return you would be filling out, right here there would be a thing saying, and I'm probably not going to be able to type it in because it won't let me, but there would be a thing saying see Statement 1, and on Statement 1 there would be that penalty of $50. So let's say that I have $1,000 of book income. Included in that, I have $100 of penalty of $100 of tax-exempt interest income, and I also have $50 of penalties. Everything else that's on my books is either deductible or includable. It's deductible if it's an expense, or it's includable in income if it's income. So now I can do my reconciliation. So what it tells you to do is add lines 1 through 4 here. So I have 1,050 here. And then it tells me here on line 8, add lines 6 and 7. So line 6, oh, and by the way, I need to carry my 100 over here, right? Because I might have more than one kind of income sitting on my books that's not taxable on the return. If I have more than one, then I would, like let's say I also have some life insurance proceeds. So life insurance proceeds where the company or the partnership is the beneficiary of the policy, those are not taxable. So let's say that the proceeds were $50. So now I'm going to add the 100 and the 50, and I'll have 150 here. Okay? And so now line 6 and 7, the sum of that is going to be, oh, and here, let me explain this. So you might have a situation where, I had to let my dog in. You might have a situation where you have been depreciating something for book purposes straight line over 5 years. And so your depreciation for the year was, for book purposes, was $30. But for tax purposes, and let's say that that depreciation was on an asset that you had just bought during the year. So you bought an asset for $150, and you bought it right at the beginning of the year. So if you're depreciating it straight line over 5 years, you would take $30 of depreciation in year 1 for book purposes, correct? But for tax purposes, there's this concept, this code section in the code called, and it's section 179, that tells you that certain assets that are purchased, if you meet all of the rules, can be expensed in the year of purchase, 100%. So you don't have to depreciate them over a number of years using some method of depreciation for tax purposes that's allowable. Instead, you can use the method which is 100% expensing in the year, and that's called a 179 deduction. So in this case, my depreciation on that asset would be $150. I bought it for $150, and I'm gonna take the entire thing as a 179 deduction. I'm gonna expense 100% of it in the year of purchase. So now you can see I have a difference between the book depreciation and the tax depreciation. So I have to list here those differences, okay? Now you can do this one of two ways. You can list the excess tax depreciation over book depreciation here, and in that case you would put 120 here and you would not have anything here. Or you can list your book depreciation here and your tax depreciation here. Does that make sense? You can do it either way. Either way will be right. And some people prefer to do it one way or over the other. But you do need to list the difference between your book depreciation and your tax depreciation on Schedule M1. So now if I add lines 6 and 7, I have, and I have to bring down my total here of all my items on line 7. So now my total of lines 6 and 7 is $300. And on line 9, I subtract 8 from 5. So on line 5, I have 1,000. Oh, I don't have 1,050 anymore, do I? I have 1,080 now. Okay, so it's 1,080 minus 300, and that's 780. I hope. Yeah. Okay, so now I have 780. Now, that 780 should tie to this figure right here. Okay? because this figure here is the sum of all of your items of income and then minus all of the items of deduction. So you can see 12 to 13D. So 1 through 11, you can see that's all of your items of income, 1 through 11. And then 12 and 13, 13A, B, C, D, those are all of my items of deduction. These items down here on lines 14, 15, 16, they are items that we will be passing through separately to the partner, but all of those items there, lines 17, 16, 15 and 14, those items are somehow included in lines 1 through 11 and 12 and 13. The exception is, it also tells you that you have to capture line 16L. And if you look on what 16L is, 16L is your total foreign tax expense. And that's because you actually pass through foreign tax expense separately on Schedule K and on Schedule K1. So it's not included in your other tax expense up as part of your ordinary business income. So in other words, if you have foreign tax expense, do not include it up on line 14 in your calculation of ordinary trade or business income. Instead, include your foreign taxes on Schedule K on line 16L. And then remember that it's going to get subtracted in your total here. But in this total right here, that total should actually tie to this total. Now this total, your total net book income, should tie to your income statement from your client, okay, your book income, and it should also tie to this line on Schedule M-2. Because Schedule M-2, line 3, says net income or loss per books. Now what Schedule M-2 is supposed to be doing is calculating, rolling forward the total balance of the partner's capital. And let's say that at the beginning of the year it was $2,000, and then there was nothing contributed by any of the partners during the year. Oops. But I did have a cash distribution of $200 to, I don't know, either one or more of the partners. It doesn't matter. It could have been to one partner or 5 of them, but you list the total here because this is for the whole partnership. Okay, this is a reconciliation of all of the partners' capital in total. And let's say that I had nothing else going on. So now the balance at the end of the year is just, here I just add down lines 1 through 4. So lines 1 through 4 of Schedule M-2 is 3,000. And then on line 6 and 7, on line 8 I add line 6 and 7, so that's 200. And then on line 9, I just subtract 200 from 3,000, so I get 2,800. Okay, that balance, that 2,800, ties to the balance sheet, total partners capital at the end of the year. And the total partners capital at the beginning of the year on the balance sheet needs to tie to line 1. This is a beautiful thing. You can see that all of these schedules tie back and forth to each other. And when you're reviewing someone else's tax return that's been prepared, that's what you would do, is you would check all these totals to make sure that they tie back and forth. They have to tie back and forth. Otherwise, this tax return is not in balance. And it likely points to some problem with the tax return. Okay? So I'm done kind of walking you through this. I want to stress again, please use your instructions. I used the instructions with the very first tax return that I filled out. I did have an accounting major when I filled out my first tax return, but I had a degree in accounting. However, I had not ever filled out a partnership return or any return before, other than an individual return. Okay, it's 45 minutes long. I'm sorry for such a long lecture, but I hope this has proved to be helpful to you guys, and I'll talk to you soon.